This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Both forward contracts and money market hedges were over-the-counter approaches. You had to go in, sit down, negotiate with your bank manager. But that would enable you to negotiate very precise amounts to be covered and very precise dates and so on. Futures contracts and later on options contracts are not over-the-counter. They're market-based approaches. You can buy and sell basically items on the market, which is going to help you to reduce your risk. Futures contracts are standardized contracts for the sale or purchase at some time in the future of a set quantity of currency, but the size of the contract is standardized. Okay, so you can't say I want to have a contract for £52,923. It's going to be rounded to the nearest contract, really. And you can't say I want it for the next 10 days or the next 21 days. It's a set date in the future, usually 3 months away, or very often 3 months away. The contracts have a market price, and as you buy and sell them, and the market price changes, you can make gains or losses on these contracts. And the market price follows the exchange rate approximately, not exactly. It'll jiggle up and down a little bit, but it approximately tracks the actual exchange rate. And the name of the game will be that if you fear making a loss on the currency transaction itself, you organize the purchase or sale of futures to make a profit on your futures. So the loss you've made on the currency contracts is offset by the profit you've made on the futures contracts. The downside is that if you were to make a gain on the underlying currency transaction, you would make a loss on the futures transactions. But again, you've got essentially a cancelling out. The name of the game is not to make the best possible return. The name of the game is essentially not to have any gain, but also not to have any loss. If you want to remember a rule, the rule we will see will be essentially do the same to futures now, buy and sell, as you would do to the currency in the future. It's best way of seeing it is a little example. So here we have Bramley. It's in the US. It needs £5 million on the 30th of September. That's 2 months away. And the spot rate is dollars per pound this. So let's work out which of these rates is going to be applicable to us. If you go around with £1, the bank will give you the lower of these. So this is obviously the pounds to the dollars. This is obviously the dollars to the pounds, yeah? What are we doing? We're in the US. We need 5 million. So we're going to be changing our own currency here into pounds. But that's the rate we're going to be essentially dealing with. And show the outcome of the futures hedge, assuming that the spot and futures rate will both decrease by 0.04. Okay. Now the way I like to get into this is if we are changing here, we're changing dollars to pounds. What do we fear? And we fear at the minute we're changing at 1.5352. We're going to be in quite a lot of bother in a way if this, say, were to go up to 2, yeah? Because if the exchange rate went up to 2, to lay our hands now on £5 million sterling, we would have to lay out $10 million. At the minute, we're going to only have to spend about $7.5 million. So we fear the exchange rate going from 1.53. We fear it rising. Okay, and if the exchange rate rises, goes up, the futures price will go up. So if the exchange rate rises, we're going to be making a loss on the currency we want to buy and sell futures, so we make a gain on the futures contracts. How do you make a gain if the price of something is going up? And the way you make a gain if the price of something is going up is you buy now and you sell later. If the price is going up, you buy now at the lower price and you will sell later at the higher price. You will make a profit. Now, if we go back to what we said here about this rule, if you want to look at this, do the same to futures, buy, sell, as you do to the currency. So here what we're going to be doing is we're going to be buying sterling. Remember, we're US, we're going to be buying sterling, and therefore what we're going to be doing is to insulate ourselves, or substantially insulate ourselves. We're going to be buying futures now. So we're going to be buying sterling in the future, buying the currency in the future. You're going to be buying the futures now and selling them in the future. So here really is what it's saying here. The exchange rate was to move from 1.5 to 2. The price of the futures contracts will move similarly. So profit will be made by buying futures now and selling them later. So how's this going to be working? Well, if we exchanged at the spot rate today, as we've already worked out, we'll be changing at that. Okay. So this is we're not going to be doing that. We're just saying this is, today's cash flow. We did it today. We're not going to be doing it until 3 months' time. And by then we were told that the spot rate increased. It's going against us here by 0.04. I think we need a 0.0 in here. So because the dollar has got weaker, by the time we come to change the money into £5 million, we're shelling out more dollars. So the loss on the underlying transaction, we are going to have to be spending an extra $200,000 more than we would have had to spend today. There's an adverse transaction movement against us. This is the downside risk of the transaction risk which is there. So that's the main transaction, and what we're going to have is a compensating transaction going on, because what we're going to be doing is we're going to be buying some futures now, and we were told that the futures price today is 1.423, so it is the buying price, and then we're going to be selling them in the future, and we were told that the price would go up by 0.04, so the 0.04 is in here, and it's going to be on the 5 million. So essentially the gain we're going to be making on the futures price is this is an absolutely perfect hedge we'll be talking about here. The futures price goes up, we make a profit on that, and that compensates us against the effect of the exchange rate also going up, where we're going to be making a loss. If the exchange rate had moved the other way, then we'd have made a gain on this bit of it, but we've made a loss on that bit of it. But that's okay. The name of the game is to try to reduce any nasty surprises, but inevitably you're going to be reducing the chance of some nice surprises as well. It's to get certainty from it. Let's see another example. Here we are in the US, we're going to be receiving 10 million. The last example we were paying 10 million. The spot rate here, so this is if you're going to be changing pounds into dollars, and this is going to be changing dollars into pounds. So you go along with your £1, you're going to be given a fewer amount of dollars here. Here we are going to be interested in this one here. Okay, this is a rate which is applicable if we go along with 10 million and say give me dollars for that. Say the futures price today is 1.5423, and we have the same little movement on here, 0.04. Now we can go the long way round, or not the long way round, but the kind of explanatory way round here. What do we fear? Well, we're getting 10 million. And what would happen if again the exchange rate moved, so let's say the exchange rate went to say to £1 per $1, if it went to parity, then of course this 10 million would only come up to be $10 million. At the moment, if we change 10 million, we're going to be getting about $15 million. So we fear the exchange rate going down. If the rate goes down, futures price goes down. Because we're told that the futures price tracks, not perfectly, but tracks by and large the exchange rate. So we're going to make a loss when the rate goes down, that's what we fear. If the rate goes down, the futures price goes down, how do you make a profit on something whose price is going down? And the way you make a profit on something whose price is going to be going down is you sell now at the higher price and you buy later. Now don't worry that you're selling something you don't have. The important thing is that you have bought it by the time you have to come to deliver it. So we can sell now at a relatively high price and we can buy later at a relatively low price. We're going to be making a profit on that. So this profit will enable us to compensate ourselves for the loss we're making on the underlying transaction. And again, going back to the rule here, in 3 months' time, we are going to be selling currency. We're a US company, we are selling dollars, and the rule is you do with futures now what you're going to be doing with the currency in the future. So we're selling the currency in the future, we sell futures now to generate the compensation. So that's just explaining what's kind of happening there. Again, here we have it going down. If the futures went down from 1.5 to 1.2, we're only, we're going to be disappointed, if you like, in what we're going to be getting out. We're going to be getting only $12 million instead of nearly $15 million. So sell futures now and buy them later is what we need to be looking at. So let's see this example. So if we had our 10 million now and we changed that to today's rate, which we'd argued was this rate, then we are going to be getting 15.134. It's asked us to assume that the spot and the futures rates both decrease. So the decreases here, it means we're going to be getting fewer dollars to a pound. So the new rate is going to be this one here. So this is only going to give us here 10 times 1.4734. The spot rate less the decline, 1.4734. This is really our transaction, our downside transaction risk. We're losing 400,000. However, we've taken the precaution of selling futures now at the current spot rate, or the current futures rate at 1.423, and we're told that both of them decrease by 0.04. We're going to sell later there. So we're going to be making our compensating gain in there on the futures. So always in futures contracts, you've got this kind of yo-yo effect going on here. If you're going to gain on the underlying currency transactions, you're going to lose on the futures. If you lose on the underlying currency transactions, you're going to gain on the futures, and these will offset one another. When we move on to or from forward contracts to futures contracts, the main differences are as follows. Currency futures are standard contracts, whereas forward contracts are bespoke, over the counter. Currency futures are traded in the open market. forward contracts are traded over the counter. The contract price is in dollars. In forward contracts, there are many more options that may be available. In currency futures, there are flexible closeout dates. Let's not worry about that too much. But when forward contracts, you say, I'm going to be coming in 3 months' time, and so on. You're kind of locked into that. Whereas you can choose to actually sell your futures. If you bought futures, you can sell them anytime you like, rather than waiting maybe until your original plan came to fruition. They're cheaper than forwards. You can almost guess here that with forward contracts, you're going in, you're negotiating something special service from the bank. There's going to be a service charge, a commission there, whereas futures can be cheaper. However, this is going to be pretty much a precise fit. This is probably not going to be a perfect hedge, so generally not a perfect hedge. It's a standard contract that won't fit maybe exactly what you're trying to buy and sell in currency. But also we said that the futures price doesn't precisely mirror what the exchange rate is doing. And you end up with something called basis risk. Basis risk is the source of risk, if you like, meaning that the futures market doesn't behave maybe quite as, like in clockwork, or as perfectly as you might quite like. Options is radically different to everything we've looked at before. Options will give us the opportunity of making big profits and avoiding big losses. Everything so far has not given us the ability to make profits and avoid losses. It's saying we're going to end you up where you thought you would be. It's going to give you certainty. And the important thing here, it's the right but not the obligation for the holder of an option to buy or to call or to put, to sell a foreign currency at a specific rate in the future. So if you're selling something, you're putting it up for sale. That's how to remember the put. And you buy your options. This is like a contract, it's like an insurance policy which gives you the right to exercise it. In other words, you insist on people adhering to this contract and fulfilling it, or you can just forget about it, if that's better. They can protect you against currency losses, but leave open the opportunity of benefiting from currency gains. They're extremely useful if cash flows are uncertain. You want to protect yourself, but then you don't want to be locked into the closing out a contract if the money isn't going to be needed. Because there's a kind of heads I win, tails you lose here, the other thing is there's an upfront non-returnable premium. It is very much like an insurance policy. You can insure against your house burning down, but you pay that premium whether or not you need the insurance or not at the end of the year, whether you've actually called on it or not. If your house burns down, you will waive your insurance contract at the insurer and insist that you get your money. If the house doesn't burn down, essentially the insurance policy lapses at the end of the period. So let's have a look at a simple example here. French company is importing goods costing dollars, 200,000 from the US. The current exchange rate is dollars per euro, 0.75, and payment will have to be made in 3 months. And the currency, the company buys a 3-month option for 4,000. That's the premium, this 4,000. And what's called an exercise price of euros per dollar, 0.77. In other words, this is an exchange rate it can insist on if it wants to insist on that. And what will this company do under these two circumstances? If we have spot the rate in 3 months' time at either 0.7 or 0.8. So let's just see whether we're multiplying or dividing by this 0.75 here. Basically, this is saying here that 1 euro, or $1 here, is equivalent to 0.75 euros. Okay, So what we're going to do is going to be multiplying by this here. If $1 is worth 0.75 euros, $200,000 is going to be worth 150,000 euros. Okay. So if the spot rate didn't change at all, we'd be looking forward to euros in here of 150,000. But then there is this danger it's going to move to one of these. So let's work kind of through that there. Example 1. What will the cost of the import be if the exchange rate is 0.7? So here we have to change $200,000. It's going to be changing at this rate here. It's going to cost us 140,000 euros. Essentially, the euro is worth more per dollar. It's costing us less euros to put our hands on $200,000 there. So that's what you get using the spot rate. If you were a bit odd about it and you insisted in using the forward rate, the forward rate is allowing you to change at 0.77, then $200,000 change at 0.77 if the option is exercised. So basically you have a choice. You can either insist on fulfilling the option contract or you can let it lapse. And of course here what you're going to do is you're going to let it lapse. And the total cost of these imports will turn out to be 140,000 plus the premium there. It's cost you 144,000 euros to purchase this product. What happens if the euro were to go the other way? If the euro were to go up to 0.8, so you're getting more euros to your dollar. It means that the euro must be worth less. It's moving adverse here. So your $200,000, you change them at 0.8 here, it's going to take you 160,000 euros. So you could change 160,000 euros into $200,000. Or you can say, look, I've got this bit of paper. It says I'm allowed to change the money at 0.77, not 0.8, 154,000. And in this situation, you would insist, you would hold people to this contract, you would exercise the option. Far better you're paying 154,000 than 160,000. And here the cost of the goods would be 158,000. The premium plus the value of the goods as exercised under the contract. We will never have to pay more than that. It didn't matter what the exchange rate went to. The exchange rate could go to €1 to $1, could go to €2 to $1. But we've got this stop here, which allows us to say we'll never have to pay more than 158,000 euros. But if the exchange rate moves favourably, then we might have to all be able to change it at less than what we were expecting. So it leaves open for us the opportunity of making use of favourable currency movements, but protecting us against adverse currency movements. But do remember the upfront premium payment to get this form of insurance. If the foreign currency flows are not certain, it's extremely useful. So just reading through this, imagine you're putting in a bid for a US contract, you're putting it in US dollars. If you win the contract and you're going to be getting US dollars, then your profit margin or your profit is going to depend on what those dollars translate into your own currency at. Let's say it's pound sterling. And if by the time the contract is paid for, maybe 6 months' time, maybe a year's time, if the dollar has weakened and you put that into your currency, you could actually be making a loss on the contract. However, if you were to take out a forward contract, I will go to the bank in a year's time with my $10 million I'm getting from the contract, and you didn't win the contract, you're nevertheless going to have to close out that contract. And you could maybe make a loss on that. So what you can do is you can take out an option. You can say to the bank, I want an option to come to you in 1 year's time with $10 million, what exercise price will you quote me? And if the $10 million comes in, see whether it's worthwhile exercising the option or whether to just translate the money at its then spot rate. If you don't win the contract, then let the option lapse. You don't have to turn up with that money at all. So it's basically part of the bid cost is what we've got there. Finally, we can look at the valuation of options here, and they have got two, if you like, determinants or two variables which say what the option is going to be valued at. This is the purchase and sale price kind of on the stock exchange, really. The first is a current price and an exercise price, the current price of a commodity and the exercise price. So let's say a put option. Remember, a put option allows you to sell here. So the put option, let's get away from currency. Let's just say it's a commodity. Let's say that the exercise price on this commodity it allows you to sell a ton of this commodity at 1,000, but its current price is only 800. The market price is only 800. So this is a put option, it's allowing you to sell. So what you would do is you would exercise this. You would say, right, I will buy at the market price of 800, and then immediately I will insist on exercising my option rights and I will sell at 1,000. So there's an immediate profit in there of 200. This is sometimes known as being in the money. Okay, we can see we can make a profit from this. If it was a call option, it would be working the other way. The intrinsic value would be the current price minus the exercise price. So let's say it was a call option that allows you to sell. Okay, and let's say that the exercise price here is going to be a call option is not a sell. A call option is a right to buy. A put option is you put up for sale. A call option is a right to buy. So let's say what we've got in here is we've got the right to buy at 800. So the option price is, let's say, 750. We can go out and insist on buying at 750, but the market price is going to be, let's say, 780. So that's in the money. There's an intrinsic value there. If I own this bit of paper, it means I can go out and insist that I buy stuff at 750 under this call option, and then I go to the market and I sell at 780, and I'm making 30 profit on that. The second element which adds to the value of options is as follows. And again, think of insurance companies here. The time value. The volatility of the underlying security. So if you have a security which is whizzing up and down wildly, it's exposing you to great risk. Okay, and can you see it almost intuitively that if you're exposed to this very kind of volatile risk here, then buying an option to insure yourself is worth something. Whereas if you were looking at a commodity which hardly ever moves there, why would you buy an option at all? You're only kind of insuring against a very remote possibility of a movement there. So the insurance for very volatile options is going to be worth more than insurance for very stable commodities. The time period to expiry, this is just like saying if I buy an option for 3 months, it gives me 3 months insurance. If I buy an option for 9 months, it gives me 9 months insurance. The longer the life of the option, the more you're going to be prepared to pay for it. That's kind of pretty obvious. And finally, there's a general level of interest rates here. So let's look at a call option. Let's look at an in-the-money call option. So remember, a call option allows you to buy here. Here we have an in-the-money call option here. We have a market price of 780. We think this market price might go up in the future. But what the call option, if you think the market price is going to go up in the future, one of the things you could do is buy now and sell later, of course. But if you have the call option up your sleeve, you don't have to buy now. You can wait until the option's about to expire and then buy. So you don't have to spend the money now to make money on this in-the-money call option. It defers expenditure. And if interest rates are high and you defer expenditure, then it's allowing you to keep money in the bank for longer, earning a bit of interest. It's going to add some value to that option.